Ivan Haverlin. With me here today is Jean Benedict. We are financial consultants from Personal Financial Strategies. I've been in the financial service industry since 2008. When I was 18, I started my own business that helped me pay for college. And I graduated with honors with a bachelor's in finance. My studies were specifically focused on personal finance, investment strategies, market and security analysis, derivatives, portfolio analysis. Gene has been in the financial service industry since 2004. He has got experience planning for Medicare benefits. He also has background in retirement planning, and Gene has graduated from Indiana University. Heading up the team at Personal Financial Strategies is Les Goldstein. He's been in the business for almost 30 years. We also teach a big picture retirement planning workshop at Oakton Community College. It's a lot more intense than this class. It's about 9 hours long, 3 sessions, and so he heads that up. He's also a Money Smart advisor for Federal Reserve Bank of Chicago and a member of Financial Planning Association. The vice president at PFS is Robert Hart. He's been in business for over 26 years. He's experienced with planning for high net worth families and tax planning and wealth transfers. He's also a member of Financial Planning Association. Another financial consultant is Rich Huberger. He's been in the industry for 20 plus years. Experience in highly appreciated real estate, tax planning for that, and has been with PFS since 2000. We also have a estate planning attorney on staff. Greg Terza has solely practices estate planning. He's a member of the Wealth Council and is also a former co-chair of Education Committee for Illinois and Wisconsin Estate Planning Forum. On staff, we also have a CPA, Larry Brown. He does tax planning for 300 plus PFS clients. He also does closing transactions for business and real estate and has been with Les for over 25 years. All right, I like this picture because I hope I look that good when I'm older. But really, if I knew how long I was going to live, retirement planning would be a lot easier, right? I agree on that. That is by far the biggest risk you face, is outliving your money, right? And so that's where Social Security comes in. Take a look at some life expectancies. Main assumptions for Social Security and some of the strategies we will be covering today is that typically women outlive men. You can see by this chart that on average, if an individual was born today and it was a male, he would live about 76 years, and if it was a female, she would live about 81. And if you're about 60 or 65, the difference becomes smaller, but there's still an evident difference. If you were 60, you'd live, and a male, you would live till about 81. And if you were a female, you would live till about 84. Now, obviously, there's other factors that would be taken into consideration: your health, family history of any disease. But it's important to know what at least Social Security standards for your life expectancy is, because that's how we plan. We need to know the time horizon. So we have this crystal ball at the office that tells us the life expectancy of people, but it recently broke. So if you have a crystal ball, we'd be happy to borrow that. Understanding Social Security. Most people tend to underutilize Social Security. They don't understand all the benefits. They tend to minimize, unintentionally, they tend to minimize their own benefits, spousal benefits, survival benefits. We'll shortly touch up on those benefits. One of the benefits of Social Security is you can't outlive the income, right? So the longer you live, the more money you get from the system. Now, some people have called this a Ponzi scheme because, how can somebody on Social Security collect in excess of $1.1 million when they have probably paid in a lot less? However, it's a pay-as-you-go system. So myself and Gene, we're paying into the system for people like yourselves, baby boomers. When you retire, that will pay for your benefits. So if somebody is receiving $2,000 today and they live 10 years and they collect the benefit, they're bound to receive an excess of $300,000. If they live 20 years, that climbs well in excess of $500,000. And if they live 30 or more years, you're going to collect $1.1 million. Important to note that this is for one individual. So if there's a husband and a wife, you're going to collect almost twice as much as that, because two benefits that you'll be collecting. Another benefit of Social Security, and something that you could buy in equities market, but there's a price to be paid for this, and Social Security you already paid into, so you might as well utilize that, is the cost of living adjustment, right? Also known as COLA. This is the inflation adjustment that's made by the Social Security Administration every year. We use 2.8% when we plan for our clients because that's what Social Security Administration uses in their short-term estimates, and that's a relatively conservative number. So if you're collecting that same $2,000 benefit for 10 years, at the end of that 10 years, your benefit will climb to $2,636. If you're collecting for 20 years, it will be $3,474. And if you're collecting for 30 years, it will be about $4,580. Assuming the 2.8 cost of living adjustment. Again, that is not something that's guaranteed. It changes. There are some years where there is no cost of living adjustment, and there are some years where it's 7 or 8%. So, but 2.8% is definitely a good estimate. Again, if it's a couple, your benefit will be almost twice as much. Another benefit of Social Security, people tend to underutilize, is the survivor benefit, right? So let's say there's two spouses, and since we said that women typically outlive men, let's say the man dies first, well then the woman can go and collect her spousal benefit, right? The survival benefit. So in this example, let's say they both, the husband collects $2,000 and the wife collects $1,200. After the husband dies, she can go ahead and notify Social Security Administration that she wants to collect spousal benefits. In this situation, it makes sense. Obviously, there are situations where the woman has a higher benefit on her own work or on her own work record, and that wouldn't make sense. So you came out here today to hear some questions that we feel like baby boomers want to know. Obviously, you want to know if Social Security will be there for you, right? There's been a lot of negative, over the years, there's been a lot of negativity associated with Social Security. It's insolvent. Will it be there for you? That's one of the questions you must be asking yourself. Another one is, if you will collect benefits, how much will you collect, right? When should you apply for benefits? How to maximize these benefits? There's different strategies. Gene will talk about these strategies a little bit later. Claim now, claim more later, file and suspend. And will Social Security be enough to live on? I can give you a short answer to the last one. You probably won't. Typical retirees, Social Security accounts for about 40% of their income. So question number one, will Social Security be there for you? It will most likely be there for you. It's very likely it will be there for Gene, and it's highly unlikely it will be there for me. All right? So we can take a look at what Social Security trustees say about the fund. At the end of 2010, it had, the trust fund balance was $2.6 trillion, a little bit more than $2.6 trillion. And as you see in 2011, it grew to $2.67 trillion, a little bit more than that actually. And here are the results for 2012. Total income is taxes collected, right? So if you're still working, you pay about 6.2% Social Security tax. If you're not self-employed, your employer pays about 6.2% of Social Security tax. So that is the revenue for the fund. The total expenditures are benefits collected by current retirees, right? So they're collecting a little bit less, $786 billion. And the net increase in assets is about $54 billion. So the trust fund balance at the end of 2012 grew to about $2.73 trillion. You can see that the trust fund balance is growing at a decreasing rate, right? It grew a little bit more and then it grew a little bit less. That's because baby boomers like yourselves are retiring. But the reason it is growing in general is because also baby boomers like yourselves you're in your peak earning years, right? You probably had a career where you worked, and right now you're probably making most money you've ever made. And so therefore you pay more taxes, and the trust fund is growing. Here's long-term projections. Again, this is published by the Social Security trustees on an annual basis. And the important thing to note here is that up until 2033, if there is no reform, right, if Congress doesn't pass anything, 100% of your benefits will be paid. And then if nothing happens, if no reform gets passed after 2033, still 75% of the promised benefits will be paid. Right? So because the fund has such huge reserves, you can pay out the benefits for the next 30, 40, actually until 1980, 86, where yet if nothing happens until then, you will go down to 73% of your benefits. So here are some proposals being studied. Increasing the maximum earnings subject to Social Security. For 2013, it's $113,700. Like I mentioned earlier, you pay 6.2%, your employer pays 6.2%. It's about 12.4%. About $113,000 are subject to that. If you make $150,000, the remainder is not subject to Social Security taxes. If they raise this guideline, then they will collect more Social Security revenue, right? Which will help the fund. The other thing is raising Social Security normal retirement age. Now, this is already done to a certain extent. If you were born between 1943 and 1954, your full retirement age is 66. If you were born after 1955 through 1960, or 1959, excuse me, your full retirement age is 66 in a combination of a couple months. And then if you were born after 1960, it's 67, right? So they can go ahead and scale that even more, depending on, they can put brackets over there. This will obviously affect your benefits directly, and this will affect the cost for the Social Security trust. Also, lowering benefits for future retirees is probably not the most desirable proposal that you would vote for. Again, so there's a formula involved in calculating the benefits. It's quite complex. We're not going to get into the details, but it's based on consumer prices, and they would recalculate, they will redo the formula to base it on wages. And then reducing the cost of living adjustment. Like I mentioned earlier, 2.8% is a reasonable number to use. It's different every year, so it's not guaranteed. But if they reduce the cost of living adjustment, effectively they're reducing your benefits. The bottom line is Social Security will most likely, with the high probability, will be there for you. Probably won't be there for me, maybe for Gene. Okay. Another question you must be asking yourself is how much can you expect to receive? Like I mentioned, it's a pretty complicated formula. I didn't see many people come with a calculator, so we're just going to go through general guidelines. So Social Security, your primary insurance amount depends on how much you earned over your working career and at what age you apply for benefits. You can directly, you may not be able to change how much you earned, but you can most definitely affect at what age you apply for benefits. Right? And again, Gene will be talking about some creative strategies you can maximize benefits. So this is just a general rule of how they do it. At age 62, they look at your working career, or all the years that you worked, they index those years based on inflation and price index. They tally them up, and they pick out the highest 35 years. Right, they take these 35 years and they average them out. Once they have the average, they apply these 3 band points. And what really these band points are made to do is that if somebody was making the maximum, straight out of college, they were making the maximum money subject to Social Security taxes, their benefit will not be twice as much as somebody who is making half for their whole life. It's intended to boost the benefits for lower earners, and it kind of flatlines the benefits for higher earners, right? Because really the system was designed for lower earners. And then each year it's adjusted by the cost of living adjustment, if there is one. Here's the full retirement age. I mentioned this before. If you can write down what yours is. If you were born between 1943 and 54, it's 66. Between 1955 and 59, it's a combination of 66 and a couple months. And then after 1960, it's 67. Note that after 1960, there's no more brackets, so to speak. So this was one of the proposals to go ahead and scale that down even more, so that if you were born, say, in 1970, your retirement age would be 67 and 8 months or something, right? Now, the FRA is an important term. It stands for full retirement age. It's important because if you delay your credits, right, if you delay claiming Social Security past your full retirement age, you earn something called delayed credits. Currently, it's 8%. I don't know how many people here can get an 8% guaranteed return somewhere, right? Interest rates are almost non-existent. And so here's how it affects your benefits. If you're 66 and your full retirement age is 66, you get 100% of your benefit. Every year you delay, it grows by 8%, up to a maximum of 132%. If you're 67 and you claim at 66, you actually get a reduced benefit, right? You get about 93.3%. If you're claiming your full retirement age, you get 100% of your benefit. And then, so on, it grows 8%. You can see from this chart that somebody that has a full retirement age of 66 is at a slight advantage that it's somebody that has a full retirement age of 67, because even if you had other income to live until 70, you can only maximize your benefit at up to 124% of your primary insurance amount. Whereas somebody who has a full retirement age of 66, they can actually maximize their benefit up to 132%. So they get 8 more percent, and it's locked in for life, right? So you would get an increased benefit forever. And in the situation of spousal benefits, your spouse would get an increased benefit forever. I should take that back, not forever, until you pass. So the spousal benefit is about half of the primary worker's insurance amount, or 35% if started not at age 66, or at full retirement age of the spouse, right? So if a spousal full retirement age is 66, and they start the spousal benefit at 62, they only get 35% of the primary insurance amount for the worker they're claiming under. For example, there's John and Jane. John's insurance amount is $2,000. Jane's insurance amount is $800. If Jane applies at her full retirement age, whether it's 66 or 67, for spousal benefits, she can collect $1,000 on her husband's work record, right? And he can still delay his credits and earn that 8%. Again, Gene will touch up on this a little bit. He'll go into more detail because it's one of the strategies. Here's some rules for spousal benefits. Yeah, you can read this over. Obviously, the primary worker needs to be eligible for benefits, right? The spouse needs to be at least 62, and it doesn't pay for the spouse to wait. So like I mentioned, if you wait from 66 to 70, you can get the 8%. It doesn't pay for the spouse to wait past her full retirement age, right? So you would claim that as soon as you could. Another benefit of Social Security, and you can't even if you wanted to go and buy this with an annuity, you can't have this, is the divorce spouse benefits, right? So it's pretty similar to spousal benefits. If somebody was married 5 times, all 5 ex-spouses could claim the benefit under that primary worker. But the marriage has to have lasted at least 10 years, right? You can't go marry somebody for a year, divorce, and go claim Social Security benefits. The person receiving a divorced spouse benefits is currently unmarried, because if you were married, you would claim the spousal benefits under your current spouse. And the ex-spouse is entitled to Social Security, retirement, or disability benefits, and is at least 62, just like the spousal benefits, so you need to be at least 62. Survivor benefits, there's many benefits of Social Security. If a spouse dies, and both are receiving Social Security, the widow may receive the higher benefit of the two. I used the earlier example with the $2,000 and $1,200, and when the husband died, the wife can go collect the $2,000 benefit. So this is pretty much the same example. If Joe's collecting $2,000 and Julie's collecting $1,200, upon Joe's death, Julie can notify Social Security and collect an extra $800. Right? That's significant for some people. You don't have to whip out your calculator and do number crunching to estimate your benefits. You can go online, socialsecurity.gov/mystatement. You can go to ssa.gov. Again, enter some information, and they would be able to tell you what your benefit is, at least estimate. We can also estimate your benefit for you if you go ahead and do the private workshop with us.
So, what are the factors when considering applying for your Social Security benefit? One is your health status and life expectancy. I have a great aunt who just turned 101 this summer, which means that she has outlived what her life expectancy was supposed to be. Social Security has paid her a lot more than what they anticipated. She also suspended her benefits until she was age 70. Because of her working career, she was able to put off her benefit for as long as possible and roll up the maximum amount of delayed credits. And then for the last 31 years, she's been maximizing her Social Security benefit. The other thing we need to look at is somebody's need for income. Yes, you can get your benefits at 62. But we're going to talk about a couple of scenarios of why that may or may not be something you want to do. The longer you wait, the more the delayed credits, as well as the COLAs, the cost of living adjustments, roll up that number. And then with the way life expectancies are going, you can look at any actuarial chart, people are living longer. Look in your family. Do you have a great aunt? Do you have a grandmother, a parent that went into the late 90s? Like I said, my great aunt just turned 101. She's still doing well. We expect her, we don't know, but I think 105 is not out of the question. But these are things you really have to look at yourself. Where am I health-wise? Do I think that maybe I might not live that long? Maybe, heart disease and some other things run in my family. Maybe that could make your decision where, yes, I do want to take it at 62. But that's why some of the things that Yvonne was talking about and through the rest of the presentation, Social Security benefits, and when you take them, are very individualized to yourself and to you and your spouse. And that's why I want to make sure that I hammer home. This is an individual choice that you need to look at, check out the calculators, and find out your maximum benefit. All right, so here's a couple of numbers and some slides. Sorry about the size. Didn't realize that some of the people in the back were going to be so far away. What if your PIA, your primary insurance amount, is $2,466? You'll see at full retirement age 66, you get 100% of that at $246. If we back that up to age 62, you only receive 75% of that benefit, or $1,850. Or if you delay down to age 70, it ends up at $3,255. With the COLAs built in, and again, we average at 2.8. That's what the Social Security Administration uses for an average. The 2.8 is not guaranteed. A couple years ago, I think you remember, you may have some parents that are on Social Security. They did not have the annual increase, all right? And there's some people that were pretty irritated about that. The 2.8 is not guaranteed. If you delay from full retirement age up to 70, those 8% delayed credits are guaranteed, all right?
Was that 8%, did you say?
Yeah, you can see right here, at age 66 full retirement age, you can receive 100% of your PIA, which is your primary insurance adjustment, primary insurance amount. At age 67 is 108%. So yes, it's an 8% roll up after full retirement age up to age 70.
Up to the age of 70.
70. At age 70, you're going to want to make sure you claim your Social Security benefits. There is no benefit after age 70 to delaying your benefits. All right?
Is age 70 your actual birthday, or is it January 1st of that year? How do they do it?
Your birthday?
Actual birthday.
All right. So, why delay with benefits? More income later. If you claim at age 62, and again, we're going with that primary insurance amount at age 66 of $2,466. If you claim at age 62, you can see you're getting about half the benefit that if you wait for 8 years and claim the maximum at age 70. All this slide's really representing is, if you delay, there is a serious impact in the amount of monthly income that's going to be coming into your household. And remember that the survivor benefit, the survivor gets the benefit of the highest earning member of the married couple. So, if, as a male, and I earn a little bit more than my wife does, I wait and claim my benefit at age 70, when I pass, she gets that survivor benefit. That's one of the things that we actually, I'm 42, and that is one of the things that we are currently discussing and working on to make sure that in her retirement, that she has enough monthly income built in, both with Social Security as well as our other assets. So, when to apply for Social Security and key points to remember. If you apply early, your benefits start lower and they stay lower for the rest of your life. COLAs, the cost of living adjustments, this was that number that's 2.8. It is not a guaranteed number. Sometimes years it might be a little bit more, sometimes a little less. And yes, in the recent past, there's been 2 years back to back, I believe, where they didn't have a cost of living adjustment. The decision impacts survivor benefits as well. Delaying benefits may give the surviving spouse more income. This is what I was just talking about in my personal situation. I'm looking to try to make sure that I don't take my Social Security retirement benefits until age 70, which will guarantee my wife the maximum amount possible when I pass. All right, so how can we maximize our benefits? Improve your earnings record. So Yvonne talked about the fact that we average, or the Social Security Administration averages your best 35 working years. If you have more than 35 working years, they take the highest 35 working years. I believe there was a question of what happens if there's 10 years where I don't have an earnings record. Well, you get averaged in as 0, all right? What happens if I only have 25 working years? Well, then you have 25 numbers that go into your average, and then you have zeros added for the other 10 where you didn't actually earn an income. And you know that you need 40 quarters, or basically 10 years, to be eligible to receive Social Security. The other thing you can do, for the most part, the Social Security Administration is accurate, but you can go to socialsecurity.gov/mystatement. Make sure all your years are in there. Check it against your mental, what did I earn? Make sure that record is accurate. And if it isn't, contact them with proof to be able to go in and say, hey, maybe we need to readjust this, maybe we need to look at it a little bit different. And then lastly, can you improve it by working longer? Yvonne alluded to this as well. Most people earn a little bit more later in their careers. So yes, and this gentleman in the front row also was asking, what if I work past 66? Yes, you can actually increase that average, all right? So if you're making over $113,000, if remember that's the number that Social Security caps out for Social Security taxes, if you're making up at that number or above, you'll be earning the max that you can against your Social Security retirement benefits, which means that your average will go up, right? Yes, ma'am?
Well, what happens if your husband is trying to wait until he's 70 before he claims his Social Security, and he should die before that occurs? What happens in that case? And he hasn't
You can get your survivor benefit at whatever age he is that he passed.
Oh, okay.
Yes, sir.
I just want to refine my question a little further. Is there any penalty after the age of 66 for earning money? Any punitive measures?
We're going to go over that in just a second. The answer is a qualified yes. and it has to do with the taxation of your Social Security benefit. So it is how much money you're earning will depend on how much your Social Security benefit will be taxed. So will the actual benefit be reduced? Not because Social Security is saying that you're working, we're going to withhold some. It's, I'm earning, so my paycheck is pretty high, so a greater portion of your Social Security benefit will be taxed. And we do have some stuff on that here in just a second. All right, so apply for Social Security at capital time. Things you need to consider. We talked about this a little bit earlier. Your life expectancy, your income needs, and your spouse's life expectancy. The longer you live, the greater the benefit Social Security will be to you. All right, the annual earnings test. And this is what we were talking about a little bit earlier about if I work during Social Security, how does that affect me? So, currently, if you apply for Social Security before full retirement age, and everybody in the room is going to have a little bit different full retirement age. Yvonne had a slide up there a little bit earlier, so you kind of know about when your full retirement age should be. If you claim your benefit before full retirement age, then yes, you are subject to the earnings test. And what does that mean? In 2013, if you earn more than $15,120, $1 in benefits will be withheld for every $2 you earn. What does that mean? That means that if you're making $30,000, about $7,500 is going to be withheld. Now that doesn't mean that you're not going to get it. You will get it later. It will be basically suspended. You'll get it at full retirement age, and they'll redo some calculations in there. But you will have a reduced Social Security benefit if you work during retirement, from early retirement to full retirement age. That's very specific. Then, to avoid the earning test altogether, wait until full retirement age or later to apply for benefits. What does that mean? After your full retirement age, if you continue to work, they're not withholding any of the benefit, your Social Security benefit. There are some tax implications, which we're going to go into here in a minute, but you are not subject to the earning test if you still are working after full retirement age. Remember, everything here hinges on full retirement age.
But if you're not collecting Social Security at that point, it doesn't matter, right?
No, it does not, because you haven't applied for Social Security benefits, right? So we're talking about when you actually apply to receive your Social Security benefit.
Right.
All right? So if you wait till, most of these slides will say 66 because that's full retirement age for most folks. If you wait till full retirement age, the earnings test does not apply. All right. Coordination of spousal benefits. The file and suspend. Again, Yvonne alluded to this as well. At FRA or full retirement age, the higher earning spouse applies for his benefit and asks that it be suspended. What does that mean? At age 66, he applies for his benefit and asks for it to be suspended. That means it is getting those delayed credits, all right? What does that mean for the spouse? The spouse then files for the spousal benefit, and the higher earning spouse claims the benefit at age 70 after they've received the maximum amount of delayed credits for their Social Security benefit. So the example here, Bob and Barbara are both age 66, full retirement age. Bob's PIA, or primary insurance amount, was $2,000, and Barbara's is $800. Bob wants to delay his benefit until age 70. Barbara wants to file for her spousal benefit now. So Bob files and suspends at age 66. Again, full retirement age. This entitles Barbara to her spousal benefit while Bob's benefit continues to earn delayed credits. Also, and there was a slide that Yvonne had, spousal benefits do not get the delayed credits. So once you're full retirement age, claim your spousal benefit, it doesn't go up from there. All right? Some folks think that if you keep delaying the spousal benefit after age 66, that it's going to roll up the same as the primary earners. It's not the case. Spousal benefits at age 66 are the maximum they're going to be, subject to the COLAs, the cost of living adjustments, but those aren't guaranteed. All right, claim now, claim more later. At FRA, full retirement age, the higher earning spouse restricts his application to his spousal benefit. The lower earning spouse must have filed for her benefits on her record. At 70, the higher earning spouse switches to his own maximum benefit. Here's the example. Mike and Mary are both 66. Again, full retirement age. Mike's primary insurance amount is $2,000 and Mary's is $800. Mary files for her benefit at age 66. Mike files for his spousal benefit at the same time and begins collecting $400, half of Mary's. So what happens? When Mike turns 70, he switches to his maximum benefit of $2,640. This is with the delayed credits. And Mary adds on her $200 spousal benefit for a total of $1,000 for her. Remember, Mike's $2,000 is getting 8% a year from age 66 to age 70. And that's why instead of being $2,000, it's $2,640. Remember Mary? She gets to claim half of the $2,000, which is why her $1,000 is down here. All right. Now, a lot of people ask, well, why wouldn't I file and suspend or claim now, claim more later, and then do the same thing with my spouse? Social Security Administration doesn't let you do it. It's a rule. Only one spouse may do this. Both spouses can't receive spousal benefits on each other's record at the same time. It'd be great if you could, but you can't. A lot of people ask. I wish you could, but nope. All right. So, minimize taxation of benefits. This was a question we had up here a little bit ago. Married and filing jointly. If you make under $32,000, your Social Security benefit is not taxed. If you're married and filing jointly and you're making between $32,000 and $44,000, 50% of your Social Security benefit will be taxed. Now that's in your tax bracket. That's not, they'll take 50% of it. Oops, I'm sorry. Back. Over 44%, up to 85% of your Social Security benefit can be taxed. Single head of household, the numbers come down a little bit. Under 25, they don't tax you. 25 to 34, up to 50%. Over 34, up to 85% of your Social Security benefit can be taxed. Now lastly, married filing separately and living with your spouse, you just jump right to the 85%. This is on provisional income, which is adjusted gross income plus 1/2 of your Social Security benefit plus tax exempt interest. Again, this is why the calculators come into play, because I can't do this stuff in my head. There are a lot of calculators out there that will make, I don't want to say make it easy, but certainly give us a roadmap to walk down. All right. Coordinate Social Security with your overall retirement plan. What Social Security personnel can and can't do. What they can do, they can estimate your individual benefit. Remember, go to Social Security, the website, and / my statement, and you can find out exactly what your benefit's going to be. And they can tell you the amount that you're entitled to now. Here's what they don't do very well. They can't project future benefits through scenario planning. They average 2.8% in, but they can't really tell you that because it's not guaranteed. There are cost of living adjustments, but like we said, several years ago, they weren't paid. What they can do is say, if you delay your benefit past full retirement age 66, we can factor in the 8% that you're going to make on your benefit. But what we can't do is find out what it's going to be with the cost of living adjustment. So, will Social Security be enough to live on retirement? Yvonne answered this question with one of the first slides that we had. Social Security makes up roughly 40% of the average individual's retirement income, which means you need to make up 60% somewhere else. And where do we do that? We make it up with pensions, IRAs, 401ks, required minimum distributions on those, your investment portfolio, and working in retirement. All right? This is where your overall plan is going to make a huge difference in when you actually apply for your benefit. Should you take money out of an IRA or 401k so that you can delay taking that Social Security benefit? What are the pros, what are the cons? This is where planning and making sure that you do the right thing at the right time makes a big difference. There are calculators out there. There are ways to go about this to make sure that you're maximizing your benefit, making sure that you work all this into one plan for both you and your spouse. But it is imperative that you do this stuff as individuals and as couples to make sure that you're maximizing your return. Because what we want to do is make sure that we have as much money in our pockets during retirement as possible. All right, you have questions, we can help. We talked a little bit about when you should apply for Social Security. What if I want to keep working? We talked about that as well. What if I already applied? We didn't talk about that so much, but there are some implications on that as well. mainly to do if you want to keep working. How much will my benefit be? We talked about how the calculators work. How can I coordinate my spousal benefits? We talked about 2 different strategies there. And what's the best long-term strategy for my situation? What we really talked about there is that is an individual choice. And that's something that you're going to have to go through for yourself, and you and your spouse go and make sure that you're doing the best for yourselves. Everybody's earnings record is a little bit different. Everybody has a little bit different pension plan, 401k, or other asset. So, what do I do next? Well, we can help. If you want, Yvonne did mention that we do have a complimentary Social Security retirement benefit workshop that we can go through with you. We're more than happy to sit down, run your information through some calculators, find out what's the best benefit strategy for you and your spouse are, and then at that point, it's up to you to make your decision, and that would be what you would do next. So, contact us for help with calculating Social Security benefit, break-even analysis, income gap analysis, crafting an optimal strategies, survival benefit plan. Whether you're divorced, again, Yvonne, my partner for the first half, and I am Gene Benedict, and we are at PFS, Personal Financial Strategies.